Welcome back, economic warriors, to Boss Economics World, the only show that calls out the financial clownery of governments, central banks, and corporate overlords with the ferocity of a caffeine-fueled economist on a deadline. I'm your host, the one and only Boss Economist, here to slice through the jargon, dismantle the propaganda, and expose the hot mess that is our global economy. Buckle up, because today we're diving headfirst into the Federal Reserve's latest stunt, slowing down its balance sheet shrinkage, and oh boy, does it smell like a government-induced dumpster fire. Now, if you've been following the news, or, let's be real, doom-scrolling X for the latest economic horror stories, you've probably heard the Fed's big announcement. Starting April 1, 2025, they're tapping the brakes on quantitative tightening, QT. For the uninitiated, QT is the Fed's attempt to undo the financial sugar high it's been feeding the economy since the 2008 crisis, and then supersized during the pandemic. They've been letting treasuries and mortgage-backed securities, MBS, roll off their balance sheet, shrinking their monstrous $6.8 trillion pile of assets. But now, they're slashing the cap on maturing treasuries from $25 billion to a measly $5 billion, while leaving MBS runoff untouched at $35 billion. Why? Because, apparently, the federal government can't get its act together on the debt ceiling. Shocker, right? But hold up, this isn't just some technical tweak for the finance nerds to geek out over. Oh no, this is a screaming red flag waving over the smoldering ruins of economic stability. So, grab your coffee, your calculators, and maybe a stiff drink, because we're about to unpack this mess from the surface to the core, exposing the economic sins of our so-called leaders and how their incompetence is dragging us all toward the abyss of recession, or worse, stagflation. Let's get into it. Let's start with the obvious. The Fed's decision to slow QT is a direct response to the ongoing debt ceiling farce in Washington. For those of you who've been living under a rock, or just trying to enjoy life without thinking about Congress, the U.S. hit its statutory debt limit in January 2025. That's the cap on how much the Treasury can borrow to pay for all the spending Congress has already approved. And because our lawmakers are apparently allergic to adulting, they've been kicking the can down the road, playing chicken with the full faith and credit of the United States. Now, here's where it gets juicy. When the debt ceiling isn't raised or suspended, the Treasury has to resort to extraordinary measures, basically financial gymnastics, to keep the government running. But the longer this drags on, the more cash gets injected back into the financial system, artificially boosting reserves. As of now, reserves sit at $3.46 trillion, according to the Fed's latest data. And guess what? That flood of cash could mask critical money market signals, like spikes in short-term borrowing rates, that the Fed relies on to know when to stop shrinking its balance sheet. Remember 2019? When the Fed's QT experiment triggered a repo market meltdown, forcing them to pump hundreds of billions back into the system? Yeah, they're terrified of a sequel. So, what does the Fed do? Instead of holding firm, they blink. They slow QT to a crawl, keeping their portfolio bloated and the financial system hooked on easy money. And why? Because the government can't do its job. This, folks, is the Fed cleaning up Congress's mess, again. But don't be fooled into thinking this is some noble act of stewardship. Oh no, this is the Fed enabling fiscal irresponsibility, propping up a system that's addicted to debt and allergic to discipline. And who pays the price? You, me, and every hard-working taxpayer watching their savings get eroded by inflation and their dreams crushed by economic stagnation. Now, let's peel back the layers and talk about what QT really is, and why the Fed's obsession with it is a masterclass in economic theater. Since June 2022, the Fed has been winding down its balance sheet, letting treasuries and MBS mature without reinvesting the proceeds. This is supposed to normalize monetary policy after years of quantitative easing, QE, where the Fed hoovered up assets to keep interest rates low and markets humming. At its peak in 2022, the Fed's balance sheet hit $8.9 trillion, more than double its pre-pandemic size. Now, it's down to $6.8 trillion, but that's still a monstrous pile of financial steroids pumping through the economy. Here's the kicker, though, QT is supposed to tighten financial conditions, draining excess liquidity and cooling inflation. But has it worked? Let's look at the data. Inflation, as measured by the Consumer Price Index, CPI, peaked at 9.1% in June 2022 but has since cooled to 2.6% as of October 2024, according to the Bureau of Labor Statistics. Sounds like a win, right? Wrong. Core inflation, which strips out volatile food and energy prices, is still sticky at 3.3%, well above the Fed's 2% target. And don't even get me started on asset inflation. Home prices are up 47% since 2020, per the S&P CoreLogic Case-Shiller Index, and the stock market is still near record highs, with the S&P 500 up 24% in 2024 alone, according to Yahoo Finance. So, what's the deal? The Fed's QT hasn't tightened anything, it's just kept the party going for Wall Street while Main Street drowns in debt and despair. And now, by slowing QT, the Fed is signaling that it's too scared to let the market feel real pain. They're terrified of a repeat of 2019, when their QT experiment triggered a funding squeeze so bad they had to restart QE in all but name. But here's the brutal truth, by keeping the system awash in liquidity, the Fed is setting us up for a bigger crash down the road. It's like giving a junkie smaller doses of heroin instead of forcing them into rehab. Spoiler alert, the withdrawal is gonna hurt a lot more later. Now, let's dig into the root of this mess, the federal government's chronic mismanagement of the economy. The debt ceiling debacle isn't just a political stunt, it's a symptom of a much deeper disease, fiscal irresponsibility. As of October 2024, U.S. federal debt stands at a jaw-dropping $34.9 trillion, according to the U.S. Treasury Department, up from $27.7 trillion in 2020. That's a 26% increase in just 4 years. And get this, debt as a percentage of GDP is now at 123%, per the Congressional Budget Office, higher than at any point since World War II. But wait, it gets worse. The CBO projects that annual deficits will average $1.6 trillion per year over the next decade, even without another crisis. And with interest rates no longer at rock bottom, thanks to the Fed's rate hike since 2022, the cost of servicing that debt is skyrocketing. In fiscal year 2024, net interest payments on the debt hit $892 billion, according to the Treasury, surpassing spending on defense, $850 billion, and closing in on Medicare, $874 billion. That's right, folks, we're spending more on interest than on tanks, planes, and grandma's healthcare. And what does Congress do about it? Nothing. Instead of cutting spending or raising taxes, both political third rails, they play brinkmanship with the debt ceiling, risking a default that could tank the global economy. Meanwhile, the Fed is forced to step in, slowing QT to keep the financial system from imploding. This, ladies and gentlemen, is what happens when you let politicians run the economy like a casino, except the house always loses, and the taxpayers are left holding the bag. Now, let's talk about the consequences of this madness, because it's not just abstract numbers on a balance sheet, it's your life, your wallet, and your future. By slowing QT and keeping the system flush with cash, the Fed is delaying the inevitable reckoning. But make no mistake, the reckoning is coming. The economy is already teetering on the edge of recession, with GDP growth slowing to an annualized 1.3% in Q3 2024, per the Bureau of Economic Analysis, down from 3% in Q2. Consumer confidence is tanking, with the Conference Board's Consumer Confidence Index dropping to 98.7 in September 2024, its lowest since early 2023. And don't forget the labor market, job openings fell to 7.4 million in September 2024, the lowest since January 2021, according to the BLS. But here's the real kicker, this isn't just about a recession. It's about stagflation, a toxic brew of stagnant growth, high inflation, and rising unemployment. We're already seeing the warning signs. Small businesses, the backbone of the economy, are getting crushed by high borrowing costs and weak demand. The National Federation of Independent Business reported in October 2024 that its Small Business Optimism Index fell to 91.5, signaling growing pessimism. Meanwhile, wealth inequality is hitting obscene levels, with the top 1% now owning 32% of U.S. wealth, up from 23% in 1989, per the Federal Reserve's distributional financial accounts. And who's to blame? The government, for racking up debt like a shopaholic with a stolen credit card, and the Fed, for enabling it with easy money policies. The result is an economy that's a ticking time bomb, ready to explode in the faces of ordinary people while the elite sip champagne in their ivory towers. So, where does this leave us, economic warriors? In a word, screwed. The Fed's decision to slow QT is just the latest chapter in a saga of government incompetence and central bank cowardice. By refusing to let the market clear, they're propping up a zombie economy that's addicted to debt and allergic to discipline. And the longer they delay the inevitable, the worse the crash will be. But here's the good news, knowledge is power. By watching Boss Economics World, you're arming yourself with the truth, cutting through the propaganda, and preparing for what's ahead. So, what can you do? Demand accountability from your elected officials, vote out the clowns who treat the economy like a piggy bank. Protect your own finances, diversify your investments, hedge against inflation, and don't trust the system to save you. And most importantly, keep watching, keep learning, and keep fighting. This is Boss Economist, signing off with a battle cry, stop the madness, shrink the debt, and save the economy before it's too late. Smash that like button, subscribe, and let's take back our financial future, together.